Testing, testing, 1, 2, 3. All right. Here we are again this morning. Very excited. This is our 50th presentation here, this lab for us on YouTube. 50 times we've done this. So we are catching up to ourselves. We are finally getting to the point where we are coming close to the end of the semester, and we've covered a number of different things. We've covered what the stock market is. We've covered what the futures market is. We've learned a little bit about day trading. We put some tools to implementation. We've learned about some indicators. We've learned about the markets. Now we're learning about options. And so this is the options lab. Last night we had the options class. It was a good class. We had some technical difficulties. My worst fear about being a presenter and a teacher and an educator is that my technology is going to fail and I'm not going to be able to present my class. And we had that last night. We had some technology failures, but we did get through the class. We learned some good things. And so I'm excited and anxious to have the class here today to kind of follow up on some of that stuff and be able to do and teach the things that we were not able to do in the class last night due to technology issues. But we are going to do a quick review and then of what we learned in the class last night. And then we're going to go through and we're going to place some orders. We're going to actually put some options on. We're going to see if we can't find some optimal locations to put the options on. All the markets are rallying and have been for a little bit over the last couple of weeks. So we're going to see if we can't find some opportunities. But we're going to put options on anyway, even if they're not the greatest opportunities, because we want to learn, right? And that's what this is all about. It's more about learning than it is about profiting right now. It's more about learning how these tools work and what we can use and put them to use for. But before we do that, the markets are going to open. This is the futures market. And so we're going to watch the futures market open up here first before we jump into the options. We're just going to watch the market come out of the gate because today is going to be a big moving day. And I'm going to bring the news up here. You can see that this morning, Fed Jefferson's speech was at 4:30 this morning, my time. This is UTC 6. We're Mountain Time. So you're going to have to make the adjustments if you're in a different time zone. But core inflation rate is coming out at 7:30. We got core inflation rate year over year coming out at 7:30. We got inflation rate month over month and year over year coming out at 7:30. So at 7:30, we got 4 big reports all coming out at the same time. And you can see the markets have already looked at this as if they're going to believe this is positive news. So we got some more. 7:30, we got CPI coming out. 7:30, we got CPI. I'm not sure the difference between SA and CPI. And then at 9 o'clock, we got Fed bar speech. 10 o'clock, we got Fed master speech. Then at 11:45, we got Fed Gobbledy speech, Goolsby. And then we got at 3:30 this afternoon, we got crude oil. So today is going to be a big day. The market is going to rock and roll all day long. So if you're a day trader, you're going to have a good time today. So 7:30, the bell should go off, and these core inflation numbers should come out, and the inflation rate should come out. We'll keep an eye on this. Looks like those numbers have already come out. 7:30. Oh, let's see. So what time is it? 7:29. We got 1 minute until the bell rings. And those numbers have already come out. So we've got the consensus was 3, the previous was 3, and the actual was 2. So core inflation was low. And consensus was 4.41, and it was 4. So the inflation rate was lower than the consensus or the forecast. Forecast was 4, so it actually came in. But the core inflation month over month was lower. The inflation rate month over month, 0.1, it came out at 0, 0.4, 0.1. So that's good. Inflation rate, 3.2, 3.3. So it's coming down just a point. So now, again, for us, it's not for us to determine whether that's good news or bad news. We look at it and say it's good news. Doesn't necessarily mean the market's going to go up or down here on the open. And the market has opened. And look how slow it is. What the heck is going on here? These core inflation rates came out at 7:30 and back here at 6:30, the market took off. That means somebody knew something before the bell, before the inflation rate numbers came out. Unless my clock is off. And I don't think my clock is off. Anyway, that was bullish right here at 6:30. Now it's coming into 7:30, which is right now. And this is the S&P 500. And unless there's something I'm not aware of, well, that is a big move. So maybe it's just a scaling issue. So that market's taken off to the upside. And that is a big move right there. So maybe it's a scaling issue on the charts. So we'll see how that plays out. Yeah, I think it's just a scaling issue. Okay, so the market's moving. This is the opening bell. So we're going to watch this just for a minute, and then we'll go over and start doing options. Okay, so this is the up in the upper left-hand corner. We've got the S&P 500. We've got the Dow up in the upper right-hand corner. We've got the NASDAQ in the bottom right corner. We got the Russell in the bottom left corner. So we're watching the four indexes, the big four stock indexes. And this is in the futures market. And we can trade the stock indexes over here in the futures market. We can't trade individual stocks, but we can trade the indexes. And so these are the four indexes we like to watch in the futures market. And the reason we like to watch them in the futures market, not the stock market, is because there are no pattern day trading rules over here and we have leverage. So we can put up a $1,000 investment and we don't have any pattern day trading rules telling us that we can't day trade with anything less than $25,000, $30,000, which is what you need in the stock market to day trade. So you can open up an account over here for $5,000 and you can trade and you can have the leverage. That's a $287 move right there from that low to that high with $1,000 investment, and you can day trade it all day long with no restrictions. That's why we're over here in the futures market. Okay, so we're getting a little bit of whipsaw in here out of this opening gate. The Russell is the one that usually trends nicely out of the opening gate, opening bell, but it's giving us a little wedge triangle formation right here right now, not telling us anything that we don't want to know. Come on, guys. I think it's a scaling issue. I think this market took off so big in the morning. Maybe those numbers came out an hour early and that calendar was off. I don't know. But the market's flushing right now. So the NASDAQ or the Dow up here is flushing. So that's telling to the other markets. That means if you wanted to take a short position on the S&P, it should follow. A little crazy right now. Not sure I want to jump in right now. Now remember, first thing in the morning, it's a lot of the overnight orders are being filled, and that's what's going on right now. So we're watching. Look at that Dow. So usually those things go together. At least the S&P, the Dow, and the NASDAQ, they'll travel together. And they're not doing that right now. So when that's not happening, we kind of want to wait and sit and watch and see what's going to go on, especially on these first 10, 15 minutes of the opening bell. We're a little cautious because these are the overnight orders being filled. The Dow is dropping like a rock while the S&P is climbing. That's a little strange. The NASDAQ is climbing, trying to climb up out of here. It's whipping all over back and forth. Look at the S&P popping all over the place. Again, just to give you some context, that bar right there is a $300 bar. That's a big move. That bar has moved $300 in less than 1 minute. Let's go look at this big old bar over here on the Dow. That was a $325 bar. So this market's moving. It's not sitting idly still. It just looks like it because this was such a big move back here at 6:30. It scaled everything down. And that's the nature of these electronic charts. When we used to get paper charts, we didn't have that problem. Let's go right off the chart. So that was a $3,300 move this morning. Holy cow. So I think that the report came out. They said it was supposed to come out at 7:30. I think it came out at 6:30. Because when I pulled it up, I was looking at it and I was like, wait a second, those numbers have already come in. So those numbers were supposed to come in at 7:30 and they came in. They were already there when we pulled that up. And we are UTC 6. So, all right. I don't know what's going on there. Maybe it's UTC 5. Well, that messed everything up. So UTC 6, 730. I don't know. Anyway, those numbers were already out. And now the market's kind of trying to decide what it wants to do. Does it want to continue higher? What's the Russell going to do? NASDAQ starting to flush now. That S&P had to make that big rally right there first for people who wanted to buy, I guess. Now it's coming back down. The Dow, it was flushing while this one was rallying. So now it's following that Dow. It's turning around and coming back down. So we're getting lots of whipsaw right here. So nothing real exciting. It's exciting. That's why we're watching it, right? But nothing I want to jump in on yet. It's crazy. Crazy, crazy. Watch it here for a couple more minutes. We'll come see who's in the house. Let's go say hello to everybody. Who we got? We got Gary Thomas. Good morning, all. Gary's in the house. Nice to see you, Gary. We've got Bruce R. Good morning, all. It's going to be a glorious day. It should be a good day today. Got good news or bad news. One way or the other, it's going to move the market today. Camilla, nice to have you. Great to see you in the class. We got Thomas Shaw. Good morning, Thomas. Great to have you. We got Kirk Schwartz. Good to have you, Kirk. We got G Wiz. Nice to have you in the house, G Wiz. Looking forward to our conversation. Had a few questions. I hope I got them answered for you. B Taylor. Nice to have you. We've also got John Mackey. John Mackey. Good morning, everyone. It's good to see you, John. It's got his picture up there for us now. Brian Johnson. Good to see you, Brian. Glad you could make it. We got Michael Bruce. Michael Bruce has an appointment with me this afternoon. We're going to talk this afternoon in person, Michael. I'm looking forward to that. We've got Oliver Rohrman. Oliver, nice to have you. Glad you could make it. Bonds and notes are huge moves. We jump over and look at the bonds and notes if we wanted to. Trading research. Who we got? Trading research in the house. You're back. We had you in here the other day, and now you're back. It's good to see you. Great to have you in the morning. Rock Steiner. Good to see you, Rock Steiner. And we got Oliver Rohrman. Oliver, good morning. And then we've got John David Lumberg. Glad to have you, John David Lumberg. And if anybody else wants to pop up their little icon there and say something, say good morning, I'll make you famous. We'll put you up on the screen. We got a good class in here today, and glad to have everybody arrive. Bunch of new students from the university. And then, of course, we got a bunch of old students from old previous classes. And then, of course, we got our YouTube members who are joining from YouTube. And glad to have you guys here with us as well. Everybody's welcome to the lab. We do have classes at night at the university. And I taught the opening class to the university options class last night. And we're anxious to do a little options trading today. But I'm just watching the opening bell just to kind of see what's going on over here with the opening bell. John says that the bonds and notes are moving big. So if you guys pull up the bonds and notes, you might see some better trends. Right now, we're just kind of watching these markets bounce around a little bit. Fill in those nighttime orders. It usually takes about 10 to 15 minutes sometimes to get those all cleared out. And then the market can start to trend once again. But lots of pre-market session trading going on this morning. And I think that report time was off. It's probably at 6:30 because that's what it shows on the chart. That 6:30 we had big news. That wasn't supposed to come out according to my calendar till 7:30. Not sure who got that off. Got that wrong, whether that was me or them, but I think it was them. Okay, the S&P is starting to rally a little bit here. So again, we're here in the futures market. I'll give you a little clue of what's going on here. Just first of all, just to give you a quick introduction, my name's Lan Turner, for those of you who don't know, former instructor at the Chicago Mercantile Exchange and Board of Trades Education Center, currently instructor of finance at Utah Tech University. And this is the lab for that class. And we're just learning. This is at the university, we do the academic side of things. And then here in the morning session, we do it on YouTube because then everybody can attend. Sometimes we were trying to do it at some different locations. We're doing it at the library, having the labs at the library. That didn't work out very good. We were doing it at some people's house. That didn't work out very good. We were doing it at one of the students' airplane hangars at one point, where we were going and trying to do the lab, the trading, just trying to find a location that everybody could come and meet and we could trade. And that didn't work out very good either. So that was a long ways away. The hangar was clear out of the airport. And so I just decided, I'm just going to do it online. Why not? Just do it online. Everybody's welcome. Everybody can come. And then, of course, this YouTube thing works real well so that you can have the replay. So it's there for you to watch, at any time. If you can't make the morning class, you have to go take the kids to school or something. Then you can come back and watch the replay, watch the recording, and then that works out pretty well too. So we are here trading through the futures exchanges, Chicago Mercantile Exchange. This is not the New York Stock Exchange. For those of you who are not familiar with these markets, when trading through Chicago, there are no pattern day trading rules. You can open an account with as little as $5,000 and trade long or short as often as you like, penalty free. All right, so that's why we're here looking at the futures market, which means, of course, that there are penalties and interest rates and all kinds of things that you have to jump through to trade or do this type of trading over in the stock market. But to do this, you do need some amazing live trading platforms, a software package, and of course, the one we recommend is Track and Trade Live. You can pick that up, your futures version, at trackandtrade.com. Get a free 14-day trial with live streaming data, no credit card required. Then get it installed, come back here, follow along with us, and do what we're doing here. And this software does do options, so we will be doing options in the futures market. We're going to start today, though, with options in the stock market. It's a little bit easier to understand. So I'll teach you how to set up your charts so you can do this yourself. Make sure to subscribe so you don't lose the channel. And ring that little bell, ring that little YouTube bell so you get reminded whenever we're going to do a class. So that's an important thing to do. Subscribe and ring the little bell. All right. All right. So the market's starting to move higher again. So where the S&P is moving higher and the Dow is not, if this Dow breaks above that green line, that could be a buy signal. You could take a long position in anticipation that this market's going to follow the other two markets that have already started to go. The Russell has already started to go. It broke above the green dots right there. The only one that hasn't is the Dow. So we're looking for the Dow to rally. The others are gone. The Nasdaq's broke above the green line, the green dots. Those green dots are just all they are is the average true range. Okay, it's the ATR indicator, average true range. And so the average true range just flips back and forth from one side to the other, depending on whether the market's bullish or bearish. And then you can take that as a signal for entry if you would like. We also use filters oftentimes to tell us when a market's bullish or bearish, and then take the signals from the average true range. But I've got those filters turned off right now. We can turn those back on. It's just a simple moving average, or we'll use the bulls and bears indicator. Now it's not breaking higher. It's actually coming up against that little shelf, went up against that little top formation right there, and now it's breaking out the bottom. So it's not doing what we think, unless it's going to make a little A, B, C pattern back down. So that could be an A, B, C, and then watch that market fall. So if you want to take a position, I was looking for it to continue higher because the other markets were continuing higher. We're getting a little flag formation, this little uptrend, a little downtrend. Remember, one up for every down. We got, here's our up, here's our down, going into another up. We're getting an up again over here, a continuation. There's our little down. There's our flag. So that's our little flag formation right there. That's your pattern, lower highs with higher lows. There we go. There's our break on the NASDAQ. If we want to take that position, we could. Oh, I took it on the wrong chart. That's what land does. Land grabs the wrong chart sometime. You got to pick the right chart. You got to have the chart picked. So the S&P 500 is highlighted, and I wanted to place the order on the Dow, and I didn't have the Dow selected. I wanted to be in right there on the Dow, and I didn't do it because I picked the wrong dumb chart. So you got to have the chart highlighted that you're going to trade on. So I missed that breakout. It's a bad, stupid mistake. Beginner error. I talk too much and don't focus on what I'm doing here. See these little breaks here, the market's in a rally, but the little pullbacks, these little red bars, those little red bars right down in there. Let me blow this up a little bit. See if I can make it a little bigger. See those little red bars down in there? We'll go look at this. The market started to rally, 3 bars. That's not a very good rally. But then we got the 2 little bars back and it broke again. It broke above the green bars, better rally. Now we got a little pullback. That's a little flag. So we call that flagging, right? So a little flag right here. And that break above the flag, break above the previous high is an important place for the market to start to move higher. This is an important spot right here. Okay, that's our little double top. Now we got this big area up here looming, the previous high. We've also got this even number, 1780. That's going to be an important part. The market might go up, bounce off of that. So we got all these areas. These are called resistance points, all right? Points of resistance where the market might go up and touch these areas and flush back down. This is where people will take profits or traders will take profits at those levels, causing the market to flush back down. If it does, it gives you another opportunity to get into the market as it turns and rallies once again. We are very bullish on the market due to the, the nature of the report that came out. So we want to look at taking long positions, and there's our opportunity that we missed right there. Land should have got in, tried to get in right there and missed it. So I feel stupid. Could have got in late, but I didn't want to chase the market. Sometimes chasing the market's not a good idea. Get you in late, but this market had strength, so it went. Now that it broke above the previous high. Okay, so it really broke above that previous high. So the S&P's up, breaking all-time new highs here too. So we got a high there. We got a high there. So it breaks that high. We'll look to see if it closes above the high. Now we're coming up here on the Russell. We're bouncing against that resistance. That first line, that 1780. See, it came right up and touched it. Started to pull back against it. Market's starting to go again. It's starting to move higher. So made a rookie mistake right there and missed getting into that market. All right, here we go. We're breaking above that 1780. See if it holds above 1780. Notice the NASDAQ starting to pull back. So that's drive 1 on the NASDAQ right there. You can see that's drive 1. We got the pullback. That's drive 2. Question is, are we going to get a drive 3? Is this thing going to turn and rally and give us one more drive? So we'll watch that closely. That's a big market. Remember, this is a big market from here to here. Oh, let's see. We're on the micro mini. So we got a micro mini. So if we're on the full size, regular size, that would have been $1,300. But we're on the micro mini, so it's $130. So we have 2 different size markets in here. We have the minis, which you can see the mini is up here on the Dow, the S&P, and the Russell are all the mini. But notice down here in the bottom right corner, this is the NASDAQ. It's called a micro mini. So it's 10 times smaller in value. So if you're a new trader, you might want to trade the micro mini in anticipation of, being able to get in and trade the market, but having a smaller risk and smaller reward, of course, as well, but you don't take as big a risk on getting in. And so if you're wrong, and as a new trader, you don't take as big a loss if you're wrong. And so this one here doesn't look like we're going to make any money. We tried to get in on a break in anticipation of a third drive, and it failed. So since it was the micro mini, we didn't lose $200. We only lost $20. So here is the Dow starting to back off a little bit from that rally that we missed because I made a rookie mistake. All right. I don't see Matt saying hello today, so it doesn't look like Matt made it to class this morning. We'll see. Matt generally likes to come in and trade that Russell right out of the gate. So wondering how he did today. The Dow starting to pull back a little bit. We got 1, 2, 3, 4, 5 rally bars. Now we're getting a little pullback. The S&P starting to pull back. Oh, I feel bad. I missed my opportunity on that Dow. What would that have been? That would have been $300 already. All right. We're going to go and start doing a little options trading, should we? Since this is options class, this is our 50th class. Can you believe that? Been doing these YouTube labs. This is the 50th time we've been here. So this is class number 50. Okay, so let's go over and do a little, we got to do a little academic work. All right. So first thing we're going to do is we're going to bring up just some of the slides that we looked at from last night. This is the university course, and we're going to go through some of these slides. First thing I want to bring to your attention is that the manual to this class is online at Amazon. You can get the manual to the class at Amazon. Just search Lan H. Turner. This manual is also available if you take the class at the university. It's also available to you. You don't have to buy it if you don't want the paper version. You can get the PDF version in your portal. Now, we should be getting the passwords out to everybody who was in the class last night to the portal. Today, watch your email. You'll get your email sometime probably a little bit after this class is over. I'll make sure that they get that done. We'll get your emails out, and you can get into the portal where you can have access to the lectures, and you can also pre-recorded lectures. And then, of course, you got this manual, which will be in the portal as well. But you can go buy the manual and get the paper version if you would like out on Amazon. It's not very expensive. Try to keep the price as low as possible. So there is that. Get the manual if you would like it. We're going to do some market analysis. So I just want to do a little quick analysis on the markets, just to give you a little introduction or remind you of some of the technical analysis. Now, remember, markets, we like to think of them in two ways. We like to think of fundamental nature markets and the technical side of things, technical side of markets. So the fundamental nature of markets is what we looked at this morning, the news report, right? The news was coming out, and we were going to have good news, okay, or bad news. We didn't know. We were waiting for the news report to come out. And so that's what we were looking at in the news. So this is the fundamental nature of the market. So that's what the fundamental nature of the market is. It's these news reports. Now, remember, as we talked about in class, MSNBC, NBC, CBS, all those guys, those blather boxes, those don't mean jack crap to us as traders. They don't know anything. We know way more than they do. All right. We're well trained. We know about markets. We understand trading. We know more than they do. They might have the AP, the wire that comes across, but by the time that information comes to you and they read it off of a teleprompter, that information is old news. All right. It's way too late to come out. We can't really trade off that information. There are sources of information that come out that everybody gets at the same time. So the problem is the information that everybody has isn't usually worth having. All right. So you need to get the news at the same time as everyone else to be able to take advantage of it. And that's what these government reports are. These government reports come out. Everybody's supposed to get them at the same time. Now, obviously, there's some cheats out there, but we're not going to talk about the cheats right now. We're just going to talk about everybody gets this news at the same time, and the markets react to them at the same time. So that's the kind of news that you want. That's the fundamental information. These guys over there, MSBC, CBS, they don't have anything. They just usually a day late and a dollar short, and they're telling you why the market moved yesterday, which does you no good as a trader. So those guys, not a lot of help. The best kind of news is these type of government reports that come out. And I like to use tradingeconomics.com. Okay. Now I'm a little disconcerted right now because we were told that those prices were going to come out at 7:30, and it looks like to me they came out at 6:30. So they got their times wrong on here, which is a little disconcerting to me. There's other sources of these calendars. There's lots of websites that put out this information, but basically they're all the same. I've always really liked this one. This one's always been my favorite. I used to look at some different ones, but I've kind of landed on this one and I've liked it. But this is a little disconcerting that they were off by an hour this time. So I don't know whose fault that was, but nonetheless, or if it was a fault at all, I don't know. I'm going to have to look into it and find out why that thing was off. All right. So that was the fundamental nature of markets. The technical side of markets is all the mathematical modeling that we do. So when I'm talking about, 3-drive patterns, flagging formations, Elliot wave patterns, head and shoulders formations, all that kind of stuff. Stochastics, indicators, RSI, CMF, MACD. We talked about all these different technical tools. Now, we had a previous class to this one. This is the options class, so it's a follow-up to the other classes that we have already had. We talked about those in great detail, And so I'm not going to go into them in detail in this class because those have already been covered in previous classes. But through the lab process, we do talk about these indicators, and we'll talk and the different mathematical models, and we continue to use them. And so it's the process of using them and watching me use them that's going to help you understand them better as you come and participate in this this forum here. So the next thing is we want to talk about the accumulation and distribution model, because this is very important when trading options in particular. We want to really be very conscious of when the right time to buy an option is, because not all trades should be options. Options are very specific in nature, and they need to be, they need to kind of move in your favor very deliberately as soon as you get them. Otherwise, they have time value that continues to decay. You've only got so much time in an option. And so because you've only got so much time in an option, those markets need to kind of start moving in your favor so that it can outperform the decay of time. And we'll talk a little bit more about time decay and probably on the Wednesday class. But just keep in mind that we need to be very conscious of when we're getting into these markets. We don't just randomly go out and buy options, because they do have some downside to them in the fact that they have time decay. So one of the things that I want to be very conscious of when we're trading options is when we're going to put those on. And the best time to put those on is through the breakout of the accumulation stage. All right. So we need to know what the accumulation stage is. And that's what the Wyckoff theory is all about. So this is the accumulation stage down here in the bottom left corner. You can see it's the time when the market has a tendency to kind of just wander sideways. It looks like it's not doing much, just lots of chop down, wandering sideways in a low zone. That's an accumulation stage. That's where the banks and the hedge funds all start picking up big shares, because the way they trade is they buy low and they sell high. And then buyers need sellers and sellers need buyers. If you're a buyer, you need somebody to sell you that stock. If you're a seller, you need somebody to sell that stock too. So the accumulation stage is the stage in which the big banks, they load up on all these stocks, all right? And then as they start to push the market higher, we as retail traders jump in and jump on those big trends, and we buy all the way up that trend. All right, that reaccumulation stage, that markup phase, we're buyers as retail traders. But who's selling to us? Well, the ones who are selling to us are the big banks and hedge funds. All right, they're the ones who are selling to us during that markup stage. But once we get up to the top, well, we stop buying. They go into distribution, they finalize their trades, and they get out of all the leftover positions that they're in by doing a distribution phase, which is basically the same process as the accumulation phase, only in reverse. And then that kind of causes the market to fall and flush back down. That's why markets move through these waves. They go up and they go down. They move through waves, all right? So it's a process of buy, take profits, sell, sell. Buy, take profits, sell. The way you take profits if you bought is to sell. So the way that the big banks and hedge funds take profits is they buy down at the bottom in the accumulation stage. And then they get us all excited, us retail traders, to buy, and they start to sell. All right. So they're just working on a bigger time scale than we are. We're working on a smaller time scale. They're working on a bigger time scale. So now we're going to come in and take a look. The next thing is just to look at some of these charts. I just want to pull up and just give you a reminder of how this all sets up and works. Let me get my face out of the way. So what we're looking at here is this is just an example of an accumulation stage using a software program or technical tools to give us the idea, the indication of where these markets are at in these trends. And so what we're looking at is the accumulation stage. So this is the accumulation stage. You can see that we got the bulls and bears turned on. And the bulls and bears is a tool or an indicator that helps you identify the accumulation and distribution stages of the market. It's based on Fibonacci and Elliot wave, which is some other stuff we talked about in a previous class, and we'll continue to cover here in this class. But this is the accumulation stage, and these are the places where the big banks are buying up the shares, and then the green is where they're selling out. All right, so they're selling out. We have an accumulation distribution model down here at the bottom. You can see this chart. And it's got an accumulation. It's called the AD, okay, ADMA, moving average. So it's the accumulation distribution moving average model. And this is your indicator that lays below the chart. And you can see that this corresponds with the red zones of where the big banks are accumulating shares in the red. And then as the market starts to rally, goes through the yellow zone, which is the neutral zone, and then turns green. And that's where we all jump in as retail traders. We all jump into the market. And that's where we end up being the buyers to the big banks who are the sellers. Okay, so they're selling out at that point, we're buying in. So that's how that works. So you have to just be conscious of what's going on in the markets. If you're conscious of what's going on in the markets, then you can be a participant and, not have a, lack of knowledge of how to trade these markets. And that's what we do. We go watch the accumulation stage, watch the big banks accumulate, and then watch them sell out. Where they're selling out, we're going to buy in. But remember, they're going to eventually stop selling out. We're going to stop buying in, what causes the market to fall. That's why we get out. We take our profits. All right. Oh my goodness. I'm having FOMO right now, really bad. Let's go look at the markets. Look at this. Holy cow. We're over here doing academic work while the market's taking off and going to the moon. Look, that's where we were going to get in right there on that market. That was a good signal. Hasn't broken those green dots all the way up. So we could still be in right up into here. How much does that move from here to here? If you're day trading, it's $525. We'd have met our goal. So our daily goal is $500. If we'd have got in there and got out right where we're at right now, that'd have been a $500 move. We'd have met our, and that was with a single contract. So the Russell has been a little lazy right in here. It's not been breaking like we anticipated, but that S&P and the Dow have really been going. The NASDAQ just broke the little green lights right here. So that was a nice signal for the NASDAQ, and it's gone up nicely. This is a micro mini, so that's $56, or it would have been on the regular mini, would have been $565. Again, 10 times smaller. But that's how you day trade. You just kind of wait for these signals to come in and you take them. Don't take a big risk. If they don't go, you just get right back out. If they do go, you stay in as long as they'll let you stay in. As long as that trend wants to go, you just stay in there until it crosses those green lights again. All right. You can take profits along the way. You can build up a bigger position. But yeah, having some pretty serious FOMO here watching these markets go without us while we're doing academic work. All right, you guys can kind of keep your eye on the market, keep your eye on the class lesson material. We're going to continue our class discussions. We're going to go over and place some options orders. So this is the accumulation stage. So the best place to be buying options is just as this market breaks out of that accumulation stage and starts to go green. So we like to see this thing pop up. We generally have, if we're using the bulls and bears, we'll have a yellow zone where it leaves the red, goes into the yellow zone. And then we like to see it go green, and that's where we want to be buyers and looking for this market to break out of that accumulation stage. And that's where you want to be buying options. So, okay, so timing of options entry is very important. Not that trading stocks isn't. Of course, it's the same. We're going to use the same strategy when trading stocks, or even when trading futures market. We want to use these accumulation zones. When you're day trading, the accumulation zones are much smaller, but they still occur. All right, we're still looking for those types of patterns. So the next thing we want to do is be conscious of the Elliott wave drive. Once those markets break out of the accumulation stage, once they break that red zone and start to rally, we generally see them make 3 drives up. All right, so this is the 3 drive pattern, or what we call the Elliott wave pattern. So you generally see them break out and they'll drive one, they'll pull back a little bit, buy, sell, right? Sell is the pullbacks, that's the counter trend. And then buy again, and then the counter trend, and buy again. Those big banks and hedge funds, they like to try and push this market at least 3 times. And you notice that if you look back in history, statistically speaking, the market has a tendency to do these 3 drives out of these breakout zones of these accumulation stages. And then we'll get a little ABC pattern coming back off the top, okay? And of course, that's the distribution stage that we talked about back here. So this is your distribution phase. And when it comes back down off that 3 drive markup pattern, we get the redistribution back down at the halfway point. So that's how that all comes together and plays out. Now, does it work perfectly every single time? No, of course not. But it's a tendency. It's what the market has a tendency to do. And that's the probabilities. And so that's what we trade. We trade the probabilities. Okay. So if you want to know the probabilities of the Elliott wave patterns and those types of things, again, it's published in the manual. So if you don't have the manual, you can go get it out on Amazon, or you can get it in your portal as a PDF. And so all those probability tables are built in that manual, and you can see what the probabilities are of each one of these drives. And we talk about these, as we trade. We'll talk about, this is an X1A1, this is an X2A1, this is an X3A1, et cetera, et cetera, et cetera. This is an A drive, this is a B drive, this is a C drive. Whenever we talk about that, that's what we're talking about. We're talking about those probability tables. and which ones of those have the higher probability. Okay, so the next thing we need to talk about is options. Let's jump right in. We're going to start talking a little bit about options. Just going to give you a little introduction to those of you who don't have an introduction to options and don't know what they are. Give you a little bit of a quick description. In the options world, sorry, I'm losing my voice already. That's why I have my tea. In the options world, we have two kinds of options. All right, we have puts and we have calls. And people get confused with puts and calls, and I want to keep those straight with you. It's not that puts and calls are difficult and scary. Sometimes people get a little scared of trading options. And the question has to be asked, why? Why do we trade options? The options, buying an option gives you unlimited profit potential with limited risk. All right. They have low risk and high return. Now, that's a misnomer, low risk, because they can be risky. Options can be a little bit risky because they do have some downside to them. There's not all advantages. Anytime we're trading, there's always either an advantage or a disadvantage. There's an advantage and disadvantage to every single thing we do. If you can only see the advantage, you better not trade, because you need to know what the disadvantage is. So the advantage and the disadvantage. So we need to discover what the advantage and disadvantages are. And that's what this class is about. We're going to discover the advantages of options and also the disadvantages of options, because we need to know what that is as well. Okay. But one of the advantages is that they're low risk and high return. Okay. You have a maximum amount of money that you can lose, and you have unlimited profit potential when you buy an option. There's no margin requirements. So when you trade, oftentimes there's a margin requirement. So when we trade in the futures market, we're trading on margin. So we put up a performance bond, $1,000. Okay. That allows us to control one contract in the futures market. Well, in the stock market, you can either trade with a cash account and just pay full cash for everything, or you can get a margin where they basically lend you money, right? So they lend you money. And on that lending of money, that's called margin. So you can borrow some money and then you can invest it and get a bigger return because you're using somebody else's money, right? So when you're buying an option, there's no margin requirement. It's a cash purchase. So if you have enough money in your account to purchase an option premium, then go for it. No margin when buying options. All right. Now we'll get into when you do need some margin when trading options. And of course, that's when you sell an option. So we'll get into that here in just a second. So we need to get some logic or some terminology out of the way. All right. We need to all be kind of on the same board and understand the terminology. So the terminology when trading options is strike price. What is the strike price? The price at which the buyer and the seller agrees to purchase or sell the underlying asset. What is the strike price? Okay. So the strike price, let's jump over to the software. And oh my goodness, look at this market flushing back down off of that peak right up there. So it come up, it crossed those green dots right up in here. And it's pulling back. How far is it going to pull back? One up for every down. So we got one nice big up. We're getting it down. Is it going to continue down? How far? And then is it going to turn and start to go back up once again? So the question when it comes to trading, we know that there's basically one up for one every down, one up, one down, one up, one down, one up, one down. Sometimes they're big ups and little downs. Sometimes they're just great big ups. Sometimes they're little ups and little downs again. But there's one up for every down. The question what we have as traders is trying to determine when that up and down are going to start and end. All right. When is this start? When is the new up going to begin? When is the new down going to quit? When is it going to end? When's the up going to start? And when is the down going to end? So that was a nice, beautiful uptrend. We got our downtrend. Now we're looking for an uptrend. It may just be a little tiny uptrend like this. Maybe a little 2-bar green uptrend and then come back down. That would be a flag formation. That's what we call that. Little flag formation right in here. The market is flagging to the downside. If it breaks above those green dots, we'd anticipate a continuation of the uptrend. If it doesn't, if it stays below those green dots and makes a new low, so first candle to make a new low, we'd expect it to continue to fall back down. So that's how you make these decisions. Again, higher highs and higher lows, lower highs and lower lows don't only take place or take meaning on a longer term trend, but on an individual price bar basis as well. Especially when you're trading these short-term charts, these little 1-minute charts. All right. So This market's breaking higher, still breaking up. It hasn't broke the green dots yet. I know we're right in the middle of our academic work on options, but we got to watch the market here too, right? We got to watch the day trading stuff. Take a little break from the option stuff for a second. Watch this market flag right here. If it'll break and give us a green, you can take another short position right out of there. So the way you'd do that is you'd come in here and you grab this QOCO and drop it in there, and we'll just trail up one price bar back. If it breaks below, you could take that short position. If it breaks above those green dots, though, then we'd want to be looking at taking a long position for a continuation of the uptrend. And we'd throw away our short position. We got such good news. I don't really like taking short positions on a market that's strongly bullish, but they flush too, even with good news, because people are taking their profits. It's called a counter trend. We don't generally like to trade the counter trends, just like to trade the trends. We'll watch this just for a minute here, just to see what it wants to do. Okay. It's staying below those green dots, but it's not coming down. That's 4 rally bars, but they're flat tops right here. See, I got an order in. If it breaks a low, breaks below that previous bar, we'll take a short position. But we won't take a big risk. We'll just get right back out if it turns around and starts to go back up again. Just take real small risks in the beginning. Once you got some money build up, then you can take some bigger risks. It's going to break above those green dots. If it does, we throw this away. We don't want to take a short position. Sometimes it'll go up and just stab through those green dots and then flush. So you have to be mindful of that too. It doesn't actually close above them. So you want it to close above that mathematical model right there and hang up there and stay up there. Otherwise, we'll take a short position. And then that green dot, that would be our stop, right? That's basically where we'd put our stop. There we go. We got short. So let's see if it wants to fall. We're going to put our stop in here. And we'll just drop that right on those green dots, because if it goes back up and breaks those green dots, that means it's bullish and wants to continue higher on this little false fall out to the bottom. So we want it to continue. We want it to continue down now because we're short the market, meaning we make money when the market falls. We want it to fall. And we want it to decisively move in our favor. If it doesn't decisively move in our favor, we just get out, take a little tiny loss. We can take another trade again later, try and recover it again, try and make some money. But we don't want to take big risks because it's hard to recover if you lose a big bunch of money in hope that the market comes back in your favor. If the market doesn't move in your favor, just get out. Okay, it's not dropping. It's going to get us out. We're going to stop out one more time. It's going to stop us out. It's going to hit that green light, and it's going to stop us out. We just lost a little bit more money. Well, at least we only lost a little bit of money, not a lot. That's easy to recover. So let's get back to our academic. We tried to take a little trade here to a short position, and it failed. So the market isn't performing in the way we thought it would. So let's go back and start learning a little bit more. All right. So the expiration date is the length of time before the buyer's rights expire. All right. Before the buyer's rights expire. So we have a specific amount of time that we want to buy our option. Now we want to buy the least amount of time as possible, because the less time you have, the less the cost of the option. All right. The more time you have, the more the option costs. But there's an advantage and a disadvantage to that. The advantage is if you buy more time, you have more time for the option to become profitable. So that's the advantage. The disadvantage is that you have to pay more money for that. If you buy too short a time, the disadvantage to that is that the too short a time, now the market might not have enough time to become profitable. So you paid a little too much, too little for it, and the market doesn't become profitable for you. So there is that situation. So you got to just that's why we do technical analysis. We do Fibonacci projections. We try to figure out where the market's going to be in price and time in the future. And we make those best judgments that we possibly can based on past performance. And then we go ahead and we look and see if we can't project how long it's going to take for the market to be profitable and reach these certain areas of support and resistance. And then we want to buy enough time that the market has plenty of time to reach those goals. And that's the amount of time that you want to buy. So you don't want to buy too much time, just buying something you don't need, but you want to buy enough time that the market has enough time to become profitable. And then the premium. The premium is, of course, the amount of money that you're purchasing, the option must pay for the right. So you have to buy an option, all right? So the option is the right, but not the obligation to buy the underlying stock in this case. So that's the example there, all right? So we have puts and calls. There are only two types of puts and calls, okay? Two types of options, puts and calls. You can buy a call, you can sell a call, you can buy a put, or you can sell a put. Oh, I can't stop myself. Look at that market breaking above those green dots and going long. We were going to see if it wasn't going to break short. It didn't. It failed. And in the process, it looks like it's breaking above those green dots and starting to go long once again. You got your area of resistance right up here. Goes and breaks above that, holds above it. We're going to anticipate a continuation of the uptrend. It's breaking higher. All right. So we have two kinds of options. Puts and calls. You can buy a call, you can sell a call, you can buy a put, you can sell a put. Okay? So buying a put or a call, if we think the market is going to go up, we buy a call option. If we think the market is going to go down, we buy a put option. All right? So that's what you do. That's how easy as it is. Buy calls for the market up, buy puts for the market going down. So buying an option gives you the right, but not the obligation to purchase the underlying asset at a specified price, which is the strike price, before a specified date, which is the expiration date, for a specified cost, which is the premium. All right. So the strike price is the specified price, the expiration date is a specified date, and the premium is the specified cost. Okay, so let's go and buy some call options, should we? So if we think the market's going to go up, we buy a call. If we think the market's going to go down, we buy a put. So putting on a bearish put option, we're going to buy and hold a put if you think the market will fall. Okay, buy a put, buy a put, buy a call. So let's go do some. All right, let's go over and we're going to buy some options. And to do that, we're going to leave the futures market for now. Look at that market, left those green dots. Oh my goodness, while we were talking, it took off and rallied. It's going up. It wants to close above that previous high on the Dow. The Dow's looking good. Look what the NASDAQ's getting ready to break above those green dots too. It wants to go. Maybe, maybe not. The Dow is holding above. We got the S&P up here testing this previous high up there. It closed above, but it doesn't want to hold up there. That Dow. I want to see it stay up there, and rally some more. All right, let's go look at the stock market. Okay, here's the stock market. Boy, that thing's taken off like a rocket ship. I did a video yesterday for my trading club, and I said I took some profits right in here because I thought this market might have a tendency, if we had bad news, to fall, flush back down, just like all these other flushes. But we got good news and it went up. Good thing I didn't sell out all of it. I just took some profits off the table and left some in there. So I'm making some good money on this rally. Not as much as I could have. I took a little bit off, took some profit. There's never a bad time to take profit. So I took a little profit just in case that market wanted to fall. But we got a nice rally. So the market money that's still in there, still doing good. So I'm happy about that, making some good money on that rally. So let's come in and look at some options. All right. So the first thing we want to do is we want to look at this options table over here. On the right-hand side is your options tab in Track and Trade. Now, each software package, depending on which one you're using, is going to be a little bit different. Track and Trade is a kind of, I want to say it's an advanced program because it does things that most other programs don't. All right. And that's having drag and drop options. Now, we were the first ones in our software in Track and Trade to have drag and drop orders. To be able to come in here and drag an order on the screen like this, we were doing this 20 years ago. All right. Dragging screen orders on the screen. Now all software does that. So I don't think it'll be long before they start copying us once again and start copying this drag and drop options. Nobody else does that I'm aware of, but Track and Trade now has drag and drop options. And so you can come in here and you hit the buy call and you can move your option mathematical calculator up and down on the screen, just like you would an order. And that's the one thing that most people get confused about. When you trade options, just think about them as another order type. Okay. Oftentimes people say, well, if I'm only going to be trading options land, do I have to learn how to trade stocks? It's kind of a crazy question because an option is nothing more than the right, but not the obligation to buy the underlying stock. So you need to know how to trade the stock so that you can use the option to buy it with, because that's all an order. That's all an option is. It's just a way of buying the underlying stock. It just gives you the right to bail out if you decide you don't want to. All right. Now, the big thing about trading is that we don't generally do what we call exercise our right. Now, remember, an option gives you the right, but not the obligation to buy the underlying stock at a specified price. What is the specified price? It's the strike price. So what is the strike price? Let's go back to the basics. The strike price is the price in which the market is currently trading, or this scale right here on the right-hand side. Okay, so you have a lot of different strike prices. So the strike price table is down here in the bottom window. Let's pull that up where you can see it. And I'm going to move myself out of the way so you can see it a little better. So this is the strike price over here. So this is, you can see down here on the left-hand side, these are all your strike prices. All right. Now the strike prices, you'll notice, correspond exactly to what's going on up here on the chart, up here on this scale on the right-hand side of the price scale of this. In this case, it's the QQQs. So you can buy options at any strike price. Okay. So what that's telling you is you can say, well, I want the right, but not the obligation to buy the QQQs at whatever price I want. All right. So the most popular strike price is the current price. So whatever the price is currently trading at is the most popular strike price. So you can see that's what's in yellow here. And I've highlighted it, so now it's white. But that white line right there is the current strike price. And you'll see it's $385. Well, that's right where the market's trading. The market's trading at $384. And the current strike price, the closest one, now you notice they don't go exactly, 385, 386, 387, 387, they go within dollars. You can't buy pennies. You can't go like $3, 385.50, 385.60, 385.70. So the increment in this case is dollars. When you get into some other markets, the increment goes by $5, or the increment sometimes goes by $10 or $20. So you have broader points of strike prices. But because we're in a very popular index, which is the QQQs, it goes every dollar. So you can buy an option at every dollar. So you can have the right, but not the obligation to buy at almost any price. So if we come down here, 385, we can buy that call. We drag it on the screen. And it's an order, just like any other drop order. And we can say, okay, we want to buy an option at the current market price, which is what we call at the money. All right. So that's at the money. Now, if I was going to come up above the market, that would be out of the money. All right. And the reason it's out of the money is because it's above the market. It costs a lot less to buy an option that's out of the money. So you say, well, why would anybody do that? It gives me the right, but not the obligation to buy the QQQs at $400 when it's trading at $384. Why would I do that? Wouldn't I just buy the $384? I can buy the stock at $384. Why do I want an option that gives me the right to buy it at $400? That's a good question. And the answer to that is because when we are trading options, we don't generally exercise our right. Doesn't mean we don't. We certainly do. But for the most part, we don't exercise our right to buy the underlying stock. All right. So the fact that I buy an option with the right to buy the underlying stock at $400, even though it's trading at $384, does not mean I expect to actually take possession of the stock at $400. Now, if it goes up there, I certainly could if I wanted to. but I generally don't want to. I don't want to own the stock. If I have to buy the stock, if I exercise my right, I have to buy the stock. I have to buy 100 shares because one option represents 100 shares. So if I exercise my right, I have to come up with, in this case, $40,000 to exercise my right. Not really interested in buying $40,000 worth of the Qs. So that's why I'm not going to exercise my right. So then you say, well, then why are you trading the option? Well, because the premium of the option will increase if the market goes up. All right. So the premium of the option will increase if the market rises in price. Even though I have no intentions of ever actually exercising my right, if the market rises, that $190 that I paid for that out of the money option will increase in value. Now, let's say it increases in value by 10%. Well, 10% of $191 is 19 bucks. That would be my profit. I'd make $19 on a $191 investment because the premium would increase because it becomes more valuable as the market moves closer to my strike price or the likelihood that I might want to exercise that right. Okay. So the premium of the option will increase. Now, let's say that I buy one here at $191, a $400 call option, and it goes up 10%. I make $19. Well, let's say that I buy an at the money option right there. The at the money option cost me $847. Now, let's say it goes up 10%. Both options go up 10%. I'm going to make $84 on the option that's at the money. I paid more for it, so 10% is more money. It's more dollar amount. It's not more percent. It's the same percent, but 10% of $842 is more money than 10% of $150. Okay. So an out of the money option costs less money, but it could still make the same percent increase in value if the market continues to rise. So both options go up in value of 10%. But 10% is $15 of $150, but it's $85 of an $850 option. Okay, so that's what we're trading when we're trading options. We're trading the premium because we don't really want to exercise our right. Because if we exercise our right, we have to come up with $40,000 to buy the underlying stock. Now, you might want to do that. And that's a good way to get into the stock. If you decide that you want to do it, you can go ahead and buy an option. It gives you the right, but not the obligation to buy the underlying stock. Now, the reason we do this is because we say, well, if this market's going to rise in price, I want my premium to increase in value, and I'll sell it, liquidate it before the expiration date when I have to make that final decision. You can liquidate your option at any time, all right? And you can exercise it at any time. There are options that you can't exercise until expiration, but for the most part, the options that we're going to be trading in these markets, you can exercise them at any time and you can liquidate them at any time. So it's very easy to come in and get into a market. All you have to do to buy the option is you just drop it in there, $795. We come in. If we want to buy that option, it's a 31-day option. We have the expiration date is listed here on the screen. That's what this purple line is in here. And you can see we got it in the table over here. So this is our order entry window over here. This is our calculator right here. And I'm going to slide this down just a little bit so we can see what's going on a little bit more. And you see that we're going to pay $796 for it. Margin requirement is 0. Buying power decrease is $796. So they're going to take $796 out of our account. If we buy this right now and the market continues higher, our $794 premium will increase, and then we would take the profit. If it decreases, we would lose money. The premium would decrease in value, right? If this market turns and starts to fall at this point, and we bought an option to go long, well, the option premium would now start to fall or decrease, and we would lose the amount of money that the premium is valued at. Now, the maximum amount of money we can lose is $792. That's it. That's the maximum amount of money we can lose. Yet the profit potential on this option is unlimited. As long as that market wants to go up, we can make money. As long as it's before that purple line, because we only have 30 days. Because that's what we specified down here in this drop-down menu, right? We got a drop-down menu in 2 locations in Track and Trade, but they both work together. So you have in here, you have all these different time frames that you can buy your option length for. We just picked the 31 days. Now you'll notice in track and trade that we have brighter ones. See how these are bold and some are not bold? The ones that are not bold, these are called weekly options. All right. The ones that are bold, those are called quarterly options or monthly options. And they expire on the quarter. So 3, 31, 66, 94, 122. Those are our bold ones. Now, it's hard to teach an old dog new tricks. And so we didn't used to have weekly options. And so old dogs like me, who've been around for 30 years, we were always trading the quarterly options. And so it's hard for us to kind of go into those weekly options and trade those things. We like the quarterly options. And so we kind of have always just kind of stuck with them. And so the weekly options will oftentimes have less volume. So if you want to go to where all the volume is, and you like volume because volume gives you lots of people to trade with, you want to have volume when you're trading. That makes the spreads tighter. Now, remember, the spread is the difference between the buy and the sell, and that's your cost of doing business. And then, of course, in the futures market, when you're doing trading options, there is a commission. In the stock market, for the most part, in many instances, there are not. And most brokerage firms are still charging a little commission on options. They don't trade a lot of commissions in the stock market anymore on shares, but what they do is they kind of widen the spread. So nothing's free, but that's how they get paid in the options too. The spread, the difference in the spread. And so if we come down here and we look down here in this window, you can see the volume and you can see the spread. And you'll notice that the spread is very inexpensive. It's $2 wide, $3 wide here in the queues. That's really cheap because there's lots of participants. A lot of options get traded in the queues. And so the open interest, as you can see, is 13,900. Now, my goal is to have at least 1,000. All right. And there's 13,000. So lots of players here. We don't have to worry about being able to have our order filled or executed when we want it ordered executed. So the difference between the buy and sell in this point is $3. We would have to pay $3 to get in and $3 to get out. All right. And that's the spread, not the commission. There is no commission in the track and trade version. The clearing firm that track and trade connects to, which is called Tradeer, they are a options clearing firm and they don't have commissions. There's no commissions on options when you're trading with the track and trade software. Okay. But they do have the spread, just like any other platform has spreads. Other platforms will also have commissions. Now, in the futures market, that's not true. In the futures market, there's always commissions on options and on contracts. Okay. So it is not a commission-free area to trade. The stock market is. So as we come over here, as this market continues to rise, our option premium, because we haven't bought it yet, is continuing to get more expensive. You can see it's now $844 as that market continues to rise. Now, my goodness. All right. So now what we need to do is we need to go look at a market that we actually want to buy an option on, right? I don't really like to buy options. I don't like to get into markets that are up high. It doesn't mean they can't go higher. They certainly can, but I would have wanted to buy down in this region here, right? And then anticipate the rise in price. If we think the market's going to fall, we could buy a put option, right? So then we'd come over and we look at the price of put options. And in this case, a put option is $674 at the money. We can see the premium right there. If we want to grab our little put option tool, put option, you can come and drag it on there. And you can see over there on that far left-hand side is where the price is that you're going to pay. There's a theoretical value up there, and we'll get into that. Not today. We're going to not talk about the theoretical value. We'll get into that this coming week as we go through the classes at the university. But you can see that this is the premium that you would pay for a put option. All right. So this is the at the money put option. This is the out of the money put option. These are the in the money put option. In the money put options are going to be more expensive. Out of the money put options are going to be less expensive. At the money are going to be dead center, right? Right at the money. So it's a little easier to understand at the money, out of the money, in the money from a call standpoint, because we in our brains have a tendency to think of buy low, sell high. So again, come in here, buy a call. At the money is going to be $852. In the money, down here, it's going to be more expensive because it's already made money, $2,444. Out of the money, $192, a lot less expensive. So why isn't in the money stock so expensive? Well, because it already has built into it what we call intrinsic value, right? Because it gives you the right, but not the obligation to buy the stock at that price, which in this case is $367. Well, the market's already trading at 384. So that means you're buying the intrinsic value or the profit potential between 67 and 84, which is already made. So you have to pay for that. You have to buy that. All right. So you're buying profit. And that's why that's why the option is so expensive. So the question is, why would we do that? Well, it has to do with volatility. And again, it's beyond the scope of today's class. We'll talk about that again as we get further into the class. All right. But that's just the simple process of buying and selling options. You just look at in the money, at the money, out of the money. For the most part, us as small speculators, we're going to be buying either at the money or out of the money options. We don't buy a whole lot of in the money options. All right. So let's go and look at a couple more charts and see if we can't find something to put something on. This is the Dow. It's flying high. This is the Russell. It's flying high. Q's flying high. SPY is flying high. Everything's jumping and running really hard because of that good news we got on the core inflation rate and the inflation rate coming down. So inflation coming down is a good thing that causes the market to rally. All right, let's go look at some other charts. Let's come in here, and we've got the FANG charts in here, and we've got Apple. Apple, again, already rallying really hard. Not real thrilled about buying an option right here because it could give us that one up for every down, right? So one up, probably going to get a little down, and then we'll get maybe another up at that point. So in this case, we want to be buyers of options, call options, when this is down here in the green zone, down in here, all right, towards the end of the green zone. So this is where it starts to curl and turn on the green zone down in here. This is where we want to be buying our options, right in here, okay? So that's the locations you want to buy your options. I'm looking at the green, not the lines. Let's get this, let's remove that for a second. So this is the one we want to be buying our options right as this thing bottoms out and curls and starts to rally. Right as this thing bottoms out, curls, and starts to rally. Right as this thing bottoms out, curls, and starts to rally. That's where we want to be buying our options. Now, that's not happening right now. So we could go the other direction because you want to buy put options in anticipation of the market falling when this thing peaks out and starts to fall. When this thing peaks out and starts to fall. Now, it hasn't started to fall yet, but when this thing, and you know, you got to watch your counts. Count your waves, right? Look at how many things this drive 1, drive 2, drive 3, drive 4. It went 5 drives before it turned around. So this thing peaked out at a number of times. So if you'd have been buying puts, you'd have probably lost money all the way up that thing, anticipating Apple was going to fall, and it didn't until clear over here. And that's where it kind of went sideways, and then it started to fall at that point. So you have to do your technical analysis. You have to learn how to read the chart. You have to learn how to determine when the market's going to fall and rise. And that's when you're going to put your options on the table. All right. Oh, look at this. Girlfriend's bringing me some new hot tea. Thank you very much. She could hear me coughing out there. Oh, there we go. All right, so we got to put some options on. We got to find some place to put one on. Here's Amazon taking off to the moon. Everything's taking off, going to the moon. FNGU, this is an index, which has the Facebook, Apple, Netflix, Google. You can see there's no options on it. You can't buy options on the FNGU. There's Google. There's Meta. There's Netflix. Everything's already taken off. We should have already been into all of our positions. Let's buy one on, should we buy one on Google? Let's see. Let's buy an option on Google, all right, in anticipation of a continuation of the uptrend. So we're going to come in here, and it's very simple. There's a number of ways to do it. Again, you can buy you're going to pick your time frame. We're going to come out here. We're going to do 66 days until expiration. We drop our buy on there. We're going to do it right at the money. The closest we can get is, that's just a tiny bit above it. That's just a tiny bit below it. We're going to go with the one that's $660, just a tiny bit inside the money. And because we can't get it right on it, it's either in or out. We're going to go just a tiny little bit in. You'll notice it puts it over here in our table. It says that it is Google's currently trading at $136.38, and it's the first line in our table. So we can see that we got in here. I'll open up a little bit more. So we got $135. We're going to buy a call. We're going to buy to open quantity 1, and that's all there is to it. So now we come down in here. You can see that we got the bid is 655. We got the midpoint is 660, and the ask is 665. If we come down here and look, we got the, oh, you know what? This is on puts, and we're going to buy a call. So we got to put that over here. All right, and I don't want both. I just want calls. There we go. Okay, so there's our call. There's the one we're buying. You can see it's green down in here. Now, again, there's multiple ways to do this. You can right-click down here, and it gives you a little menu that you can say buy, and you can put your order in that way, and it'll automatically drop your marker in. Or you can just drag it with your buy and sell down here. So let's do it the other way. Let's hit cancel, clear that off. We're going to come down here and buy this 135 call. We just right-click on it, say buy, and again, it pops it on the screen for us up here. So you can do it either way. You can drag it on the screen, or you can just buy it down here. Now, what's really cool is once you have it on the screen, you can drag it and move it to different locations. Okay, and once you put it to different locations, the reason you want to do that is because markets have a tendency to move through areas of support and resistance, right? So support is on the bottom and resistance is on the top. So you want to know where your order is in reference to areas of support and resistance. How far do we think the market's going to go before it maybe runs into some resistance? Or how far is the market going to fall before it catches and receives some support? So that's what we're doing with the line that's on the screen. That's why that line is so important. All right. You want to be able to see where it's at in relationship to price. How far in the money am I? How far out of the money am I? Because the movement of the underlying market is what increases or decreases the value of your option, just like a normal order. So it's easy to think about if you think about your option in that way. It's just all I'm going to do is I'm going to buy a call option because I think the market's going to rise. How far do I think it's going to rise? Where is it going to run into some resistance? Where am I going to be wanting to take profits? All right. Or how far is it going to fall? And so now we've got our order in here at $670. That's the price that we're going to pay for it. It's a $135 call at a premium of $670. And I'm going to come in here, and we're in the demo account. All right. I'm not putting this in with real money, and we can come in and we can bid for it. Now, this is an auction. Now, when you trade options, it's an auction. And there's a couple things you want to check. First, you want to check the option volume and open interest. I like to have at least 1,000 on the open interest and 100 on the volume. All right. There's 300 on the volume. There's 13,000 on the open interest. No problem getting into this option. It's on Google. Our cost of doing business at this point, you can see, is going to be $15. Okay. That's the spread. That's the difference between the buy and the sell line, or the bid and the ask. It's a $15 spread in there. So that's my cost of doing business. This is not free. If I wanted to go up one, it's currently 15. I could go up to this one. It's only $10, and I have to pay less money, but it's just a touch out of the money. But so I could buy that one, and it would be $5 less to get in. The volume is higher. The open interest is not as high, but that would be a good one unless I could get this one at $10. So then I could come in and bid for it. And that's what this is all about. You have the bid point, the midpoint, and the ask. It's a little bit beyond the scope of what we're talking about now. I don't want to get into the bid and the ask and all that kind of stuff and what you need to bid for it. But we're going to come in and we're just going to market order into it. And we're going to say, okay, I'm willing to pay that. Well, it just dropped. It went down to $10. So we're going to pay that with a market order. We hit place the order, and we are in the market. That's all there is to it. We just bought a call option on Google to go long that expires in 66 days. All right, so that purple line is our expiration date. So we have to either exercise our right by that day, or we have to get out of the option by that day. So now what we do is we just wait, and if the market continues to rise, we'll watch our premium, which is currently sitting at $680. It will continue to rise. Our $680 will continue to grow. If the market turns at this point and starts to fall, then our premium will decrease. But the maximum amount of money that we can lose is the $680. But we won't lose that immediately. The market, it's got all the way out to here before it's going to lose all of our money. So we got time to work with this. Okay. So that is buying a call. All right, let's go do the same thing with buy a put option. Let's go over to Meta, and let's say, not that we think that Meta is going to go down, but we want to buy a put option anyway, just to example it. So let's say we think Meta is going to go down at this point. So we come and look at our puts. We're going to choose one out here that's 66 days long, plenty of time to give us time to make that decision. And you'll notice that put option on Meta right now is at the money, $1,427.50. If we come over to our options table, you can see that that's what it would cost us to buy a put option. Now, again, if we buy a put option, I'm going to right click on it, say buy. It drops our marker. Oh, that's a 3-day one. I want to cancel. We want to bring that out to 66 days. And we're going to right click on this thing and we're going to buy a put option. And there's our put option. You can see 1,420 is what we're going to pay for it. And down here, our pay 1,420. That would buy one put option, indicating that we think the market's going to fall if we think the market's going to go down. And then we do the same thing. We just come in here. I'm going to go mark it in. I'm not going to bid for it. And we're going to go place the order. And we get our order filled. Now, if the market falls, we make money. If the market goes up, we lose money. The maximum amount of money that we can lose is $1,430. And there's no limit to how much we can make if the market continues to fall in this next 60 days, 66 days. All right. So that is, we bought a put option on Meta, and now we bought a call option on Google. All right, we will leave these in here for a couple of days. We'll talk about them again tomorrow. We'll come and look at them tomorrow. They're just demo account. We're just practicing. And so that's why you have a demo account in your software, is to practice these trades. And so you can come in and you can put on a whole bunch of these just to practice. Think the market's going to go up, buy one. Think the market's going to go down, sell one. But in the beginning, don't worry too much about timing. I talked about timing. We talked about when we want to be putting these options on. But if those markets are not in that case right now and you want to practice putting some options on just to see what they do, I would recommend you do that. Go put a bunch on. We'll watch them, see what they do. You'll see how much the market moves. And we'll start talking about some different things in upcoming classes like Delta, which will tell us how much these markets are going to increase or decrease over time. And then we're going to get into more sophisticated strategies like condors and butterflies and all kinds of fun things. But in the beginning, let's just keep it simple. If you think the market's going to go up, buy a call. If you think the market's going to go down, buy a put. That's all there is to it. All right. All right, guys. I wouldn't be doing my good due diligence if I didn't bring up a little concept here little product here that you can subscribe to called Pit News Magazine. Now, Pit News Magazine kind of follows along with the articles that we're teaching in these classes. So we've been talking a lot about day trading and a lot about how to manage your money and all that kind of stuff in the classes. So in Pit News Magazine, you're going to start seeing us start doing more articles on options now. So I would recommend you subscribe to Pit News Magazine if you haven't done it yet. If you use this code down here in the bottom right-hand corner, LANLive-$1, you get it for $1 for an entire year. And again, it's how I stay in touch with you throughout these classes. We write articles. We tell you more details. It's what would normally be chapters in the manual, but the manual has already been published. And we want to write new things, so we write new articles. And instead of publishing them in a book, we put them into the magazine. So subscribe to the magazine so you can get the new articles that come out about the things that we talk about in these classes. And it would be wonderful to have you as a subscriber to Pit News Magazine. One whole year of the magazine for only $1. All right. All right. So we're coming up to the end of the class, and I can't stop myself. I have to jump over and look and see what the day trading stuff is doing. Oh, it looks like it's gotten a little tired in here. Starting to go a little sideways from where it was. We did have a nice rally. Started to slow down a little bit. What a day. What a day. All right, guys, I'm going to let you go. And if you have any questions, please let me know. And we will see you in class again Wednesday night. But for those of you who want to join me in the lab, we will be here doing options tomorrow morning, 7:30 a.m. Mountain Time. See you then.